Hey, welcome back to the final hour. It is just after 3 o'clock. Firing up the live session. Late in the day, things got a little bit more exciting for a little Monday. Typically very range bound, and you can see here that it exactly was that. Here, QQQ late in the day, officially kicking off this break of the lows around 2:30 p.m. And right now it's 3 o'clock, and this market has dropped pretty aggressively the last 30 minutes or so. Take a look at the SPY, same situation. Lots of chop this morning. Went 5 for 5 in my daily profit play. That was a fun little trade. 5 trades, 5 winners. Late in the day, this is why we don't like to have that outlier risk. The put volume sentiment has grown quite a bit. We've had this nice little waterfall of put volume growing all day, and we actually, broke the intraday lows and proceeded to then drop with a directional push of about $3 on the SPY. So we've had about a $5 down move on the SPY with a gap lower that should put us over 1% on the day. So let me go back to here. Let's take a look at the SPX on the day, comparing it to Friday's close. SPX still hasn't taken out the weekly low from last week. I'm curious how this all shakes out for the rest of the week. We have CPI news on Thursday. So close from Friday to current price, we've dropped about 1.05% just on the day. So you can see here 103 on the SPX, 102 on the SPY. Qs are down 1.15%, DIA down 1.13, Russell faring a little bit worse, 1.34. Go back to the SPY and SPX here. As I'd mentioned, not a lot of direction the last couple of weeks, and I do wonder if we end up breaking these lows. Of course, the highs are going as well. The one thing I just did, I just took this trade. If interested, I'm going to throw this in my my Discord channel for my A1 trading Pulver alerts. I put in a SPY trade because the IV has jumped and I was able to get a decent amount of premium for it. So I put in, let me see if I did a 567 SPY. Yep, so I did a 567 by 566. I just put in a bull put spread. So I'm going to throw that in. I will keep it here. That is A1 trading. This is going to be an index trade. So new trade, SPY, 11/22 expiration. Sell the 567 put, buy the 566 put, collected 70 cents credit. So this is $70 per contract profit and a $30 per contract risk. Depending on how low the SPY pushes, I'm willing to own shares at a healthy discount. So 1, we can manage as is with the 30 cents risk and accept the loss. Or 2, we can manage the long put for profit and consider taking ownership of SPY shares if you have the buying power to own at a 567 assignment price. All right, so I just added that in. Let me put in the little disclaimer with that, and I'll review that trade as well. So right here, I'm putting in, I guess I'll go to this chart here on the SPY, putting in a 567 sell put, 566 buy put, 70 cents credit. And I'll put in a little line right there. So let me dot that line if I can. There we go. That should be a little bit easier to read. Okay, so all I need price to do is over the next 45 days or so, as long as price stays above that, this is full profit. If price drops down to my 50 or my 100, I'm looking at these moving averages as opportunities to buy more or at least put in some more credit spread opportunities. So I like that trade. Let me take a screenshot here. I'll post that in my Pulver alert section. So there's that trade. There's the post. And I wonder now, let me check on my hedges. So I do have some ES hedges going on. The IV rank has jumped up a decent amount to 43. I mean, it was in the 20s and now it jumped up to 43. Let's take a look at the VIX for a moment. The VIX has spiked up to 22.45. It's up now about 16% on the day. VIX futures, by the way, was up as well. This is actually green on the day and starting to push higher. So anyway, we're up 16.7% on VIX and translating into a little bit more pressure to the downside. Now, is this a one-off event? I don't know. I mean, I looked at this as if we're a little ripe going into earnings season, that perhaps we get a bit of a pullback here, and I kind of hope that we do. I put in an ES trade that is expiration for 10. That's not right. Did that one fill? That one never filled. I put in, it's in the futures section here. There it is. So it's a 10-11 expiration. Let me check this right here. You can see my screen, right? So the 10-11 expiration is 1, 2, 3. This trade right here, if I do the analysis, current price is still quite a bit above this overall trade. If I look to close this one, so my max risk is about $7, or I'm sorry, my max risk is about $75. My max profit is $175 on the tail credit and about $425 on the profit trap. All I need price to do by the end of this week is if price is going to fall on the S&P and we get down below 56.95, that's only about another 50 points lower. Here's my trade. So this is where current price is at right there. This is my broken wing butterfly. And so if price goes back up, then I'm going to risk about $75, and that's fine. If price falls lower, then my profit trap here is good for about $8 a credit. And if it goes this way, it's good for about $3.50 credit. So with an ES trade, there's the multiplier since it's a futures contract. So basically I have $75 risk here, $175 of profit if price exceeds my trap, and then $425 per contract if I get my trap by the end of the expiration on Friday. So if this is going to be a pullback week, which it may or may not be, I'm not sure, but we're going to find out. Okay, so we'll see if this is really choppy, really jumpy. Does this market make a bit of a move, to the 50 period or so? If it does, awesome. Maybe I get lucky on that broken wing butterfly. If it doesn't, it stays choppy. That's understandable. We're still dealing with a lot of indecision here. This week, CPI data on Thursday. Earnings kicks off with financials on Friday. We do have Domino's Pizza and Delta on Thursday. Not that that's going to move the market or anything, but at least gets things going. Having a look at the last few weeks of my price, the last significant low that we had would be the FOMC low right here, and then last week's low right here. So a couple things I'll be watching. Are we going to break last week's low? If we break last week's low, are we going to have an average weekly ATR, which is going to be somewhere around $9 to $11 in movement on the SPY? So if we started out here around 572 and we go, let's say $10 to the downside, that can put us at 572 all the way down to 562, which comes in and tests that FOMC level, right? If we go back to the daily time frame, take a look at our moving averages. Is it possible that we make a quick run down towards this FOMC low, finding the 50 period moving average, and then bounce up from there over the next couple of weeks? Yes, no, maybe. So I don't know, but I'm capitalizing on a short-term trade just to grab some extra profit. I put that in the stocks option, actually put that in the index position. So new trade on the SPY, collecting 70 cents on the dollar is pretty darn good. So I'm going to take that trade, and anytime I can get a chance to grab, 65, 70 cents on an index for a $1 risk, I will do that almost all the time. Go out 30 days, 45 days, 60 days. This market finds a way to, buy a dip, or we see the market starting to go higher. It's the same trade over and over again. Okay, let me see if I've got any gamma levels here that I'm interested in. On the SPY, we have these lower levels filling up. I'm just going to put this, so I'm not going to sell this yet. I just want to see what we get for tomorrow as far as my gamma squeeze levels. But if we are looking at this index, I mean, it is very possible that 560 to 561 is in the cards for the week. So what I'll be looking at is kind of individual readings to see where these are all positioned for. If my 561 and 560 zones start to fill up with open interest and fill up with gamma squeeze levels, and the order flow start to really light up that level as a spot to get hit, then perhaps I've got a long put that I can take advantage of by maybe Thursday or Friday. and we'll find out. But we'll see. I want to make sure this fills up. I mean, we only have 45 minutes or so for the rest of the day, so I'm not going to take this trade today and waste the additional premium if we have like a pullback and a snap. It's also happens quite a bit, right? The market, very quickly sells off, and then we start to rally back up, and we kind of neutralize that position, and then tomorrow's a new day, and it's like, all right, well, what happens? Is the market going to go directional tomorrow? Is it going to stay sideways and it's just a bunch of chop? Could be all the above. So if it's chop, I'm going to stay patient. If these really fill up for good looking probabilities, then I'll probably look at an out of the money long call. I'm sorry, out of the money long put for something to trade this week. Okay, let me get some comments here. Just jumping in here. Jason's in the house. John's in the house. Daniel's here. Sistock, what's happening? What did you do to the market? Yeah. I mean, I didn't do anything. The market just knew I wasn't participating. But what I did do is I just bought, or I put in another bull put spread. Would there be a similar trade on the SPY as ES trade? Yeah, I talked about that on Friday. I put in the same trade. If you did like a 567 by 566 by 568, you could put in that same kind of broken wing trade on the SPY. I did that on Friday last week. I don't think I want to take the trade now necessarily, but volatility might be a little bit higher. So let me have a look at the SPY here. And that'd be, yeah, if you put it around like the 566 level, 565 or 566, let me see if I can price that one out. Look for a trade maybe this week. So if I put in a trade that expires on Friday, if I were to do a call butterfly, actually, yeah, that's true. I do a call fly, put it in the money. Let me see what that looks like. So if I were to kind of pin this thing at like 565, do a broken wing, I could grab about 60 cents on the dollar. The trade would look something like this. Let me see if I can show this from the curve. Nope, that's not going to show it the way that I want to. Let me build this trade out this way. So if I went SPY here, edit spread 1, 2, 3, go out to the 11th. I'll build this trade with you. So I'd sell the guts, buy the wings. If I try to pin this thing at 565, so pin it at 565 for 2 contracts, and then I would be selling the 564. I'm sorry, buying the 564 and then skipping a strike, going to the 67. See what this looks like. So this would be the trade. Real price is right here. So this dotted line is real price. You could take this on the SPY trade. You have about a 60-cent credit. You're risking about 40 cents. So not bad. And there's also a profit trap that if price were to go lower, here's your 60 cents credit. All this right here is 60 cents credit. Okay. All this down here is 40 cents. That would be your loss. Now the profit trap would be by expiration on Friday at 4 p.m. Right. So this is a pretty narrow trade. It's obviously the profit trap is very, very thin. But if we proceed lower for the week, you can keep that 60 cents. The max risk of 40 cents isn't that bad. If you want to go a little bit wider, we could maybe tweak this a little bit. So if I did, let's say I went $2 lower and went $2 higher. So now I have a $2 strike and a $4 strike. It's just going to widen out my levels. I can get $1 and I'm risking $2, right? So I'll show you the same parameters here. So if I go $2 wide, $4 wide, now I'm risking $100 to make. I'm risking $100 to make $100 on the tail credit, and my max profit, I increase the profit trap just by a little bit. If I go this way, my max profit is about $160. If I go wider and wider, now my max profit, if I trap this thing, could be $303. But we're risking about 100 to make 100 as opposed to risking 40 to make 60. That makes sense? So there's a couple ways to look at it. I mean, if this trade is going to work out, we need to see the SPY go lower and ideally get to the pin price by Friday. And that would be an awesome trade late in the day because we can close it out for about a $3 credit. So we get filled for $1 credit and still actually walk away with another $2 credit. That's an awesome trade. It doesn't happen very often. It's hard to pin price at time and expiration and price. It's very difficult to do. But in the event that we can get there late in the day, then you can probably turn this dollar credit into maybe a net $1.50, maybe a net $2 as we come into trades on Friday. Okay. Ann says, do you think the SPY was going up today? No, I didn't think that at all. When I came into today, all I looked at for today was price was sideways, and I just took my typical daily profit play. Last week when we were trading, based on this structure here, with it being really choppy and failing to make highs, this is why last week I did the ES hedge. So my /ES, which is my futures trade, I did the broken wing butterfly where I want to see if price can get into this area. And if it does, that is a broken wing that looks like this, right? So if price proceeds to go lower, I've got my profit trap. I've got my tail credit here. This is $175 a profit. This is $75 a risk. And this is about $400 a profit. So that trade was already in from Friday last week. We talked about it in my live session on Friday as well, doing it on either ES or doing it on the SPY. And I just showed you the same type of trade right now on the SPY. Okay, so I'm actually, look, I would love to see the market give us a pullback. I mean, look, a pullback is good. Technically, a pullback is warranted. A pullback would be awesome. The problem is any type of pullback like today, everyone's wondering, like, what's happening? Why is the market down 1%? I don't know. I think it's down 1% because it should be down 1%. But what's interesting is look at the Qs. Okay, I mean, the Qs are down a little bit. The Dow is in the same choppy area. The Russell has been melting down since this FOMC high in September. I mean, I'm just looking to see, like, will the market offer chance to buy the dip or buy the dip or buy the dip? If you take a look at all these simple technicals, these are still very well supported bull markets. So can we pull back into this area and have a chance to buy the dip? Well, that's the Russell. I like the trade. Can I get in a 50 or 100 and a 200 moving average trade? Sure, I can probably do some options there. How about the Dow? If the Dow pulls back, can I get a 50 or 100 or 200? Sure, but it's still a very nicely postured bull market. Okay, how about the Qs? If we pull back to the Qs, a 50 and a 100 would be great. In fact, the Qs are a bit more volatile, but if they pull back to the 50 and the 100, if they can close back above, there's a chance that we end up getting to higher levels and even testing that 200 EMA. So all three of these, including this, I mean, the SPY, the Qs, the DIA, the Russell, if they hit the 50 and 100, I'm looking at a credit spread. If they hit the 200, I'm looking at probably doubling the contracts on a credit spread. Because if all we do is maintain some posture and hold some dynamic support, these trades are going to be fine. Okay, so if it pulls back, it should pull back. I hope that it does pull back, because what this also gives the market a chance to do is, let me see if I have this. Let's see here. Let me get I got a bunch of stuff going on. Hang on a second. What am I looking at here? Is that as far back as I can go? Darn it. All right, let me see if I can find this. I've got a screenshot here of seasonality. I probably posted it in my Telegram somewhere. So right in here. By the way, today was a pretty good day for daily profit play. 5 trades, 5 winners, all before what was the latest one for profit. Today by 10:21 a.m. was out for profit. Not too bad. Let me go back into my Telegram here. I've got some images. I'm looking at the seasonality. Let's find it. This chart that I posted earlier, carve out new highs this week. Will they? If they manage to close green, everything September. I just look at this as, my charts are fairly simple, but it's like, if we can carve out higher highs, or the Dow is at the highs, the NASDAQ has a little bit higher to go. The Russell, maybe a little bit higher to go. This is the S&P on the bottom, NASDAQ and the Dow and the Russell. Okay. So, I mean, a pullback is, like I said, it's not surprising. Technically, it's due. Let me try to find some seasonality stuff here. This will take me a second. I'm curious what the heat map looks like today as we come into the final close. Like, is anything in particular, dropping hard? This one, here's a good one here. S&P election year seasonal pattern. So right now it's October, right? So let's go ahead and box this in. Let me do a highlight here. Okay, so this is the area that I'm watching. Let me just use this instead. It's not very good. All right, I'll just box this in. So from this area to this area, right? Notice what, over this aggregate of what, 70 years, 72 years in election season, what does October, November look like? Do you see October, November higher in any of these periods? Yes or no? Not one, right? So all these are offering pullbacks. This is good. Okay. Now, does the market always do this? No, the market does whatever it wants. But if we're even in the best case scenario, when we have the sitting president running, which is not happening this year, okay, that's still sideways from October to November. When we have all election years, which is the aggregate of in black, it's here. You can see there's a pullback. So there's typically a pullback on the black line, which is October to November, and then after the election, the market tends to rally. Okay, you look at so this is happening, right? We're obviously this is one of all election years. Open field, right? Open field will be interesting simply because Biden drops, Kamala Harris is now in, and that ticket still looks like if it's open field where it's two unknowns. I mean, you can argue that this is the same team as the Democrats had before, but just a different candidate. It still offers a pullback. So all these offering sideways chop or pullbacks before the market catches for November to December, even here, November to December, trying to do what it can to finish higher. Now, structurally, this is interesting because I feel like the open field side hasn't happened very often. I'm trying to think the last time. When did we? So Trump was a 4-year president, 2016 to 2020. Before that, Obama was 2 terms. George W. Bush was 2 terms. Clinton before that for 2 terms. George Herbert Walker Bush for 2 terms. Before that, I mean, I'm trying to think, when's the last time we had like a 1-term president? Anyway, it doesn't matter. But I just think it's interesting that seasonality wise, it's sideways to even getting dips and pullbacks. And so this is completely justified to see the market offering a bit of a discount. And I hope that it does. And I hope that it offers more. And I just want to have the courage to just plot some option strategies, let them generate some income, get my levels at a 50, 100, 200 if they're tested. Okay. I mean, the market's going to be a lot more hesitant and scared going into the election if we're sitting down here. Because then it looks like, oh my gosh, what if the market breaks below these lows? Well, yeah, that's a legitimate concern. Structurally, if we break below the 200 EMA and take out these August 5th lows, that's not a good thing. So what we want to see would be that type of bounce and see like this shallow 50 to 100 level. If those bounce, then the market's still going to grind away and we have maybe a 3 to 5% correction, right? So there's a decent dip of around 3% to around 5%. Structurally, that makes a lot of sense to me. So I mean, I hope we have a decent pullback. Why not? Why not get a discount? We haven't had one in freaking months. Outside of this, scary little drop in August, outside of that little, buy the dip after Labor Day, this market has just had ups, little pullback, rip higher, scary event in August that the market found a way to navigate, right? And then back to all-time highs again. So I get it. Like it seems like it's a little bit top heavy, but I would imagine this market is going to do what it can to still, stick with the seasonality. There's a lot of order flows coming in. There's a lot of leaps and destinations and open interest way out there in the distance. And we've seen a lot of forecasts also go up and higher and expecting the S&P to finish around 58 to 5,900 this year. I've even seen targets in 2025 up to 63 and 6,400 on the S&P. So even if we have a pullback, and by the way, anytime you come into the markets, so if you expect the 7 to 8% annual gains in the S&P, okay, you have to expect a 13 to 20% drawdown. How many of you out there are comfortable with that? As an investor, are you comfortable with that? This is what happens. You can't make 8% a year without having a drawdown. You can't have 8% a year going in a straight line. It seems like the market doesn't like to have any pullbacks, and we get 19% this year with having just a little hiccup in April. A bit of a Volmageddon event. It was basically the same thing as we had back in the late. It would have been 2017 and 18. And other than that, it was just super low volatility, or it was like eerily low, and it just was a short squeeze. But in order to get that 7 to 8% a year, you're taking on about 1.5 to 2 times that risk. So these drawdowns, by the way, if you were to buy a 10 and 20% discount every time it happens, I know that 2008, the market corrected 50%. I know that the NASDAQ corrected, 70 to 90%. I know that the dot-com bubble and all I know this. But if all we did was had a 10% discount that we're like, hey, that's an alarm to buy. A 20% discount, that's an alarm to buy. 30%, Okay, it's not going to feel as good, but you're buying at a discount because ultimately, give the market time. What does it try to do? Get back to all-time highs, right? You buy it at 40%, you buy it at 50%. Here's what's kind of crazy about the market. If you were to find a way, and this is rarely going to happen, but in the event that we had a 50+% correction, who can tell me what a 50+% correction is in order to get back to all-time highs? If you buy a 50% correction, it is a 100% upside in order to get back to all-time highs. Okay? That is a big jump in gains if you have the cash and dry powder to invest at discounts. Okay? Do we think that the S&P is going to go 10, 15, 20 years without making all-time highs? Probably not. I mean, we were talking about legitimate drawdowns from 2020's crash into the pullback we saw in 2022. This was one of the longer, steadier drawdowns that the market had. 2008 was a long drawdown until we bottomed out in 2009. 2001 was a big drawdown. But those discounts, if they ever get back to all-time highs, I mean, how long did it take? So we had a top here January 2022, and we recovered this literally this year. So to get to all-time highs, it took 2 years to get back to all-time highs. But if your investment, and by the way, this investment was not a 50% discount, that was about a 25% discount, but even still, a 25% gain, or I'm sorry, 25% pullback is going to be like a 35 to 40% gain to the upside. So this move to get back to those all-time highs was a 37% gain. And here we are talking about it again. So if we have pullbacks, discounts and pullbacks are okay, right? But the problem is they get really scary, and the market is basically like a little child. It's like if it gets scared, it tends to do some really stupid stuff, And also, what is a little bit scarier and nerve-wracking is that the markets tend to get a little bit less liquid. So one thing I want to check, and this is something we have to keep an eye on, is JNK. Okay, this is the junk bonds from the Bloomberg High Yield Bond ETF. What this shows us is if we have loosening credit conditions, tighter lending restrictions. Okay, anytime we've seen a rough market to trade, it's been when this instrument has been dropping aggressively. So there's your COVID drop. There's your 2022 bear market. It's been making higher highs and higher lows as of late. I just want to make sure that as I'm watching this low and this low and this low, that this thing is not dropping too much, because that would not be a good thing. If this all of a sudden looks like we're getting loosening credit conditions or tighter lending standards, then our bid ask prices are going to get wider, our fills are going to get harder, and that's not what we want. Okay, so what would be good is that this is somewhat contained and we start to chop around here or maybe find a way to go higher. That's a good thing. But if this makes these big giant drops and starts to break any type of structure, I do want to pay attention to that, because that would give me a little bit more confidence to start hedging, play some trades where I can risk very little to make a decent chunk of profit if the market's going to sell off. But I do think that the market is going to be somewhat contained to the structure of these 200 moving averages. So there's my structure right there, 50, 100, 200. Unless this market is going to violently break below this August 5th low, okay, I think that any opportunity we have to buy the dip, buy the dip, buy the dip, I'm still interested. And until that changes, until price is down here, obviously I'm less interested, right? But if we get a correction, I'm interested. If we break the structure, not as interested in trying to go long outside of maybe just credit spreads to start, maybe taking some ownership at those percentages I just talked about. If we pull back to this April 5th or this August 5th bottom, that should be around a 10 to 11% correction. That's about an 11% correction. As I said, if I were to buy shares at an 11% discount or a 10% discount or a 20% discount, longer term, that position is going to end up paying pretty well. Shorter term, I could be in for some pain and some drawdowns. So that's also why I tend to trade, I tend to trade pretty actively around the indexes if I own them, to then lower my cost basis. That makes sense? All right. All right. So JNK is something I want to watch. Chart alarms CGC. CG. Is this canopy? Yeah, this is canopy. All right, so that one's going lower. Take a look at WBA. We're trading at 8. 74. I can get this stock called away at $8 for hopefully about 35 cents a share. I'm just checking a couple things here. It's been pretty quiet. Hopefully it stays quiet. All right, global sell-off's not pretty. I agree. Yep. Let's take a look at the heat map today as things are wrapping up here in the next 30 minutes. Do we have any reasons? So dollar soft ahead of inflation data. Is it soft? A little bit. Swiss and yen stronger today. Let me update this. So Swiss and yen stronger today. Dollar euro in the middle. Aussie New Zealand weakest currencies by far. Pound CAD slightly weaker as well. Volatility wise, we had the Aussie and the Swiss drop about 130 points today. We had the yen and the Aussie and Aussie New Zealand. New Zealand yen drop about 120 to 130 pips today. So, risk on, risk off. We had a decent pullback in all those currencies. Take a look here. Crypto relationship scams pose catastrophic harm. SEC says here's how to avoid them. Obviously, don't wire money to freaking shady stuff and don't put money into things that are just crappy. I mean, I'm hoping that people are smart enough now to get out of these crypto scams. But I know a lot of people have been burned on them, which is unfortunate. Crude oil trades to its 200-day moving average. Google ordered to open Android app. FTX liquidation plan receives court approval. FX option expiries. NVIDIA is going up. Okay. Here are the best. I guess this isn't giving me the real-time news that I'm after. The market's still trying to look to maybe retest the lows. Let me go to the heat map today. All right. How's this heat map look for everybody? Only about 22% of stocks advancing today with about 7,300 declining. That's 75% of the market going down today. Amazon down a decent amount. That was like a 3% drop. Amazon down 3%. Tesla down 3%. Let me check and see where Amazon is at. So Amazon down. I do have a put on here out to November 1st. It was a hedge that gets me through earnings. I own the shares of Amazon. I've got them covered at 210. I've got them also protected to the downside at 160. I essentially did just like a big, it's like a staggered expiration, but I'm doing a collar trade. So I have a long put at 160. Let me see what that's trading for right now. Amazon. If I go to November 1st, 160. Let me check and see what I got into that debit for. I think I might be up some profit. I'm going to probably just keep it running until I have earnings. Which earnings right now in Amazon, I don't see it. Okay, October 24th. So I definitely want to get in at least to protect myself through earnings. Let's go. Okay, and then trade positions. Take a look at this summary. So my Amazon 160 it's break even right now. I'm still up about $7,800 on my Amazon shares. I'm still up around $13,000 net for a couple of positions. So that put is not quite paid out yet, but I will be watching this one. So if price, for example, goes a little bit further to the downside and does this in a fast way, I may end up taking some profit. But obviously, if we come into earnings where let's say Amazon is here and we start to get back to the 200 EMA and Amazon misses in earnings, well, that 160 put is going to also help me offset this, and I can lower my cost basis by maybe another. I'm trying to think what I paid for this one. I paid. I guess I can track it. I think I paid like $1. Yeah, it looks like I paid about $1.40 and change. So for my hedge, I paid about $1.45. So if price falls and I can turn that $1.45 into maybe a $5 or $6 credit, or in a big way, I can turn it into like a $10 credit. I mean, anything's possible, but that would be a way for me to increase my my profit, lower my cost basis, and then end up offsetting. So I own the shares here; they're covered to this high, and if I can lower my cost basis even further, rather than just a buy and hold on profits here, I can actually turn it into a bigger gain if we end up going back to these highs and getting it called away later. So I can, this to me is my percentage booster, but I have to have it, trading both ways. So anyway, U.S. markets, pretty nasty stuff today. Nvidia up, only real bright spot, even though other semiconductors are down. Apple, Google, Amazon, Tesla, the big one. Netflix down 2.64, Disney down 3%. Eli Lilly up. Interesting rotation today. Nvidia still hanging in there. Energy doing okay. We got a lot of red out there. Like I said, about 73% of stocks declining today. We're still pretty well into the bull market territory. We have about 60% of stocks still above the 50 SMA, and we still have about 66.5% above the 200 EMA. So overall, that's still a bull market. I mean, we're still well above the 50 and the 200, which means if they're greater than those, that's still in a buy zone. And I'm just looking to see, does price come back and test the 50? Does it test the 100? And we look to see, if we can buy those dips. So energy is green today. Bright spots, really, it's just NVIDIA, Eli Lilly. Everything else is pretty red. But okay, well, that's where we're at for today. So a couple things I'll be watching. I'm watching JNK. I want to see some bonds and yields today. Anything happening there? So yields are showing green. We're getting this like pretty sharp. I actually read today like, oh, the market's inverting again. Not according to me. This is a 0.5% between the 10 and the 2-year, but we're barely hanging on to this, this reinversion, right? Or the disinversion. We got about 26 basis points disinverted. If we see the labor market getting stronger, there's a chance that this will reinvert. And I don't know if that's good or bad for the market, but I would imagine it's probably better for the market to correlate with labor getting stronger. The yields have still been going up, going up, going up, going up. Look at your bonds. Comparatively, your bonds are down, down, and down. I'm actually very happy that I closed out of my TLT position at this second high. I'm really happy. I had an 80, I think it was an 80 by 105, or it was like an 82 by 105. And it's so $23 credit on the trade. I want to say I paid like $14 and I worked the cost basis down to like $10 and I closed it for about $22 credit. So take out what I paid. I ended up making about $12 net per contract, and that was up near these highs. That was as the bond market was kind of front running the rate cycle that the Fed was going to cut on September 18th, and the Fed did. And look at what happened right after that. Look at the timing of this market. The 16th, the 17th, the 18th. This market topped out before the actual FOMC. I mean, you talk about buy the rumor, sell the news. That's it in a nutshell right there. This market was ripping where yields are dropping, bonds are rallying. That's the inverse correlation. And that was happening prior to the actual Fed rate decision. And here we are with the yields going up and the bonds are dropping again. Would I want to reestablish a position on TLT? Maybe. But I've said this now for about a I don't know, maybe a 3 or 4 month window. I would rather take any allocation in bonds and put them in gold and silver. So if anybody out there tries to follow along or track the 60-40 portfolio, historically speaking, if you allocated 40% to gold, you're performing just as well or slightly better than had you done a 40% allocation to bonds. I don't want to be in bonds. And I say that because I don't think that the spending is going to stop in the U.S. I don't know if we ever had if we have like a failed election, or not a failed election, an auction, a failed auction in the bond market. If we have a nasty bond market and a nasty auction that nobody wants to take on our debt for these short-term treasuries, I don't know what that does. But it can get nasty and volatile very quickly. And so I'd rather eliminate that exposure and just focus on something that I think the world would get behind, and that would be gold. And hopefully gold, and you can tag silver with that, and then possibly even consider Bitcoin. But Bitcoin's not for everybody as far as risk. Bitcoin's not for everybody as far as general adoption. But I kind of like it. I think that Bitcoin can do a lot of replacements. It can bring people to market when they don't have access to credit. There's ways to exchange it if obviously you want to be safe and keep it decentralized. But there's also ways to express your bullishness for Bitcoin. And I saw this today, like MicroStrategy was up a ton today. So here is Bitcoin has fallen off these highs a little bit. There's a wick, right? So Bitcoin is up to around 64 and change, fell off the highs a little bit. BITO, a little bit of a rejection. IBIT, a little bit of rejection. MicroStrategy was all the way up to 192. We're talking about MicroStrategy almost making all-time highs. How's that possible? Right? I mean, talk about correlation to Bitcoin. This actually had, almost all-time highs. So wild stuff. But anyway, I just don't want to trade bonds. That's my point. If I had a 40% allocation, I would probably just put it gold, silver, and I'd like that to be my 40% as opposed to my bonds. But If TLT comes back to an attractive price, I'll probably start another trade on it, but just treat it as one trade, nothing crazy. Okay. All right. What are your gamble levels showing? Yeah, so I talked about that earlier today. So they're starting to light up a lot to the downside. I'm getting this 561 and this 560 level to light up really nicely. The reason I'm not taking it today at 20 minutes before the close is tomorrow. I want to see if these gamma squeeze levels are just as important tomorrow. So, for example, if we close out and all these are zeroed out going into tomorrow's day, do we have this one lit up for the rest of the week, or is it something where now I get like a bullish one lit up to like 570? So, if it's really obvious tomorrow, then I don't mind taking the trade. But right now, I'd say if there's going to be a continuation lower, then yeah, I think 561, 560 are really good spots for this week. But I'm not ready to call that trade yet. So, if we chop around tomorrow morning, we start to work our way lower again, then hopefully it stands out and we can take a trade towards it. If I look to take the trade right now, IV is up, premiums are going to be a little bit more expensive. But if I were to buy a Friday 560, it's going to cost me $2 to buy it right now. I do a 561 to get $1 of intrinsic value. It's going to cost me $2.40. So it's not bad. I mean, last week we took a long put for 224, took another one for $1.80, another one for $1.50 or something like that. So anyway, I mean, they're just a little pricey on the put side. So right now, buying protection is a bit more costly. But a long put for just an intraday trade or a week-to-week trade, risk $200, and if we're right, we can turn it into maybe $300-$400. So overall, not bad. But I want to see how these line up going into tomorrow if they look good. Just getting one. If I get a 3, this is a 388 current net. I mean, that's a number that it's okay. But my favorite is when this thing is printing like 1,000, and we're just not there yet. So I don't really see this like super obvious standout gamma squeeze level. Not yet, but I will keep an eye on that and see if we can get a nice trade onto this week. Okay. All right. Any other questions? So we are pushing back down towards today's lows. I don't know if the market's going to push much lower in the next 15 minutes, but it is what it is. I'm actually kind of happy to see a bit of a correction. I'm obviously more happy to see that we had 5 winning trades this morning. We completely avoided this late afternoon drop, which is good, and we'll see what tomorrow brings. But all this is in the wake of CPI news on Thursday, earnings season kicking off on Friday. I do want to have a look and see one of the major news events that we have for the rest of this month. Once we get through CPI, we also have FOMC minutes on Wednesday, which would be interesting in the afternoon. Thursday morning, we'll have all of our CPI data. We have unemployment. Actually, the CAD is going to have the employment news. We'll have PPI. Okay, so we do have 2 doses of inflation this week. So we have CPI on Thursday, and we have PPI on Friday. So that's not too bad. It just gives the market something to digest, right? If inflation data comes in higher than expected, hotter than expected, I do wonder what changes with the Fed watch tool. I've mentioned this for the last couple of weeks now. Seeing that we have a low right here, this is a third-party inflation calculation at 1.98%, and that's currently. But the low was 1.5. And so I just kind of put in the scenario of, let's say that the market right here at a 1.5% inflation reading is now showing 1.98. That would be the equivalent of our CPI data that comes out on Thursday. That would be the equivalent of our CPI printing. Let's say that the 2.3 forecast is the low of our inflation reading, and the market gets all excited on Thursday because look at that, it's trending lower, just like the Fed said it would. But then in the next 30 to 60 days, we go up to 2.8, right? This is essentially 2%. 1.98 is pretty darn close to 2%. So we go from 1.5 to 2%. Can you imagine a CPI reading in the US going from 2.3 to 2.8 and how disruptive that can be for the US markets? Because what does the market expect to see happening? The market wants to see inflation go lower. China stimulus is inflationary. U.S. fiscal spending is inflationary. Okay, higher average hourly earnings is inflationary. Commodity prices going up, oil going up is inflationary. Natural gas going up is inflationary. 2% is going to be tough to get to if we have all these inflationary forces that are working right now. So the Fed's work is not done. And I truly think they're smart enough to recognize this. And so they're going to pivot back to inflation. Employment looks fine. Employment looks steady. The job numbers last week was probably more than encouraging to say, okay, now what's the Fed's primary goal? Inflation. And so their mandate is going to be full employment, price stability, target inflation down to 2%, and they need to stick to that. If they want to get down to 2%, and I know that they're pretty flexible. The reality is they're allowing like this 2 to 3% inflation window, but if they are going to see it go back up to 2.7, 2.8, that's not going to be good. So I think that the election, we talked about this earlier. I was in this roundtable event for a final countdown. We were just talking election stuff. One Jeffrey Turnmeyer had said that oil. Just look at the ticker CL. Right now, I mean, oil has just continued to rip. We're right back to the 200 EMA. We're trading at 77.30. If oil makes a run, this is going to be interesting. If oil makes a run greater than 80, and this is his prediction, and I don't know if this is spot on, but it's interesting. If oil's up above $80 a barrel, there's a chance that Trump's going to win. Because just like that, these inflationary pressures can put enough pressure on the market where everyone's not happy. Pay at the pump, prices going up. Inflationary pressures, they were down to a point, and now they're starting to spike back up. There could be enough, disenfranchised traders or investors, voters, for crying out loud. I never say voters. That's why. There could be enough disenfranchised voters out there to say, we want something different, right? Biden's 4 years / 3.5 years / whatever you want to say was a term, as he was replaced quickly this year with no primary to get Kamala Harris as the Democratic candidate. This is inflationary enough to possibly swing the election. It really is. So Jeffrey Turnmeyer today said if we're seeing oil in above $80 to $85, there's a good chance that Donald Trump wins the election. And it's one chart. So I just think it's interesting that if we end up going back down, let's say it hits the 200 EMA and it comes back down. Well, if we're back below 70, then Harris and current administration has a chance. But if we're up, I'd say above 80, okay, if it's above 80, I'd say the edge goes to Trump. If we're below 70, edge goes to Kamala Harris. And then in the middle, it's going to be a coin flip. There's your 50-50. And as we come into, election night or week or whatever it looks like on that Monday, I don't know. It's not just the popular vote, but it's the Electoral College. Nobody knows what it looks like now. There's all sorts of crazy, gerrymandering and drawing of the districts and how they're going to get voted on differently. So we've had popular elections not be the Electoral College vote, right? And I'm curious if this year plays out the same way. And so I just hope we don't have a lot of crazy drama for the election. I'm really over it. I've been over it since 2016. I hate the election stuff. You don't want to question our voter integrity. And I know people will. And whether it's misinformation, disinformation, you got to do a little bit more digging than what you see on Facebook. But the point is, if you turn out and vote, hopefully your vote matters. And the popular vote and the Electoral College will reflect the same thing. Because if it's not, then there's all the reason to be upset about it. Well, my vote didn't count because it was 52% popular and the Electoral College said this person won the election. That wasn't who I voted for. What the heck? So all sorts of drama there. But oil is going to be the single chart we can keep an eye on and just look at those price points. Above 80, probabilities go towards Trump. You go towards, sub 70, maybe going back to the current administration. But who knows? Also, there's all sorts of betting houses and kind of like the sports books out there that you can actually watch and track the election results as well. And they're probably better than tracking polls. There's one website like 358 or 3058, 38 polls. Is this it? 538. Yeah, this one here, latest polls. So 538, this is a really intense website that tracks everything. Who's ahead in the presidential polls? Let's find out. So right now this shows, does it show an update? General election. So showing Harris with a slim margin, 2.6 points as of October 6th. So yeah, as of this weekend. Again, does this mean anything? Nope. This doesn't mean anything until it's official, but Anyway, there's all sorts of stuff to track out there. All right, 8 minutes before closing bell. Interesting day in the markets. SPY is fighting back late in the day. Got a lot of direction here the last 15, 20 minutes. So we had a sell-off at 2 o'clock onwards, and we had another bottom out around 566.80. It's up another $1.30 off the lows. This is why I don't like to have those, especially those daily profit plays. I don't like to take those late in the afternoon because that's way too much direction, way too much sensitivity on those option trades. So that's why I'm out of them. But good wins overall this morning. You said to wait on the trade for the US dollar. Yeah, I'm waiting too. I don't like the dollar, right? Today was a pause day. If I'm looking at the dollar, look, it's this simple. To me, the dollar's this. If this market wants to have a risk on rally, this has to go up. I think this has to go down. Okay, I don't see the dollar doing this. If we go up here, pull back, and go up again, I don't see the stock market going higher as the dollar goes higher. I don't see that correlation play out very well. Okay, so if we have risk off trading and this dollar is going to get stronger for another swing higher, this puts a lot of pressure on the stock market. Right? This puts potentially risk off flows into the market, and that's probably not going to be good for these indexes at all-time highs. So for me, I'm looking for this. If we just rip up here and just pause and pause and pause and drift a little bit higher and it looks a little overextended, this area, right where we see this nice inefficiency, and you've got a good structure in here, I look for that to be a nice supply zone to sell. Okay? So if I have some confirmation, I'm looking to sell the dollar. If the dollar gets weaker, every asset I'm looking to trade has a chance to go higher. But if this dollar index is going to go higher, and swing, and we go from low, high, higher, low, higher, high, it puts a lot of pressure on the indexes to still have a correction. Okay. All right. 538 is part of an ABC, very biased. Oh, yeah. I mean, I don't care. I mean, I knew that it was a website that tracks the polls with a lot of data. I don't look at it. I don't care. I mean, honestly, if I want to follow the polls that closely, I'd look at the sports books. And I know there's a couple of them. I can't remember what they are. The Tasty Trade Network talks about them quite a bit, but I'm not that interested. I'm really not. Look, if oil can predict the election, cool. If I don't know, if CPI data this week means anything, yes, no. I mean, and part of me wonders if the prints we get this week with the CPI on Thursday and PPI on Friday, is the market going to use this early on to then say, well, look at where the inflation numbers are going into the election, even though I'm telling you, this is what I'm watching, right? This makes me nervous about inflation. Seeing that this thing bottomed out and it's now almost 0.5% higher, I think we could print a low in our CPI numbers, and then we don't see that low for like maybe another 3 to 6 months. Maybe without the Fed refocusing on pausing, or I don't think they're going to raise rates necessarily, but man, the Fed could backpedal so fast if inflation is bottoming out and no longer looking to be trending lower towards 2%. It's not going to take much. The Fed would pivot pretty hard. And they may not pivot to raise rates, but they might pivot to pause. And then all of the rate cuts that the market expects to see in 2025 would be questionable. And that changes the outlook of the market a lot, because the market was anticipating over 2% of cuts. And now it's looking more like 1.3, 1.4% of cuts. That's a big difference, maybe 1.6% of cuts. So not the same. Okay. All right. We got a few more minutes here before closing bell. BSX, what's that? Oh yeah, there you go. Is that a what is this? Anybody giving me stocks in your all-time highs, you know what I'm going to say. If we're sitting here at all-time highs, I don't care how good it looks fundamentally, I'm not buying all-time highs. BSX. So here's my snowflake analysis on it. Boston Scientific. Okay, no risk detected, which is good. Below estimated value, earnings forecast to grow. What's my price to earnings, price to sales? A little rich on the price to earnings. Let's see what it compares to. Fair value is about $90. So it's about right. And let me look at its comparison to peers. So it's above the peer average from price to earnings. I don't know. I mean, I look at the stock price and I would say, I want a pullback, man. Can we get a pullback to the 50? 50, the 100, the 200, buy a dip. It looks good. Like, it's a healthy trend, but can we get a pullback? Can we get a pullback? Can we get a pullback? That's all I'm looking for. Anybody that types in a stock, hey Chris, take a look at this. If we're sitting at all-time highs and we haven't pulled back to these numbers or these lines, I'm just waiting. I'm waiting. I'm waiting. I'm not buying crap right now. There's too much volatility. There's too much potential risk. There's too much uncertainty for me to get ham on just going long. Now, I realize that I want to get long if we have the dips and pullbacks that I'm talking about. If we have a dip and a pullback, look, this is going to make traders nervous, right? If we pull back to the 50 and the 100 moving average, this is going to make traders nervous because we're going to have a healthy correction. But from that level into the election, yes, we could have some more volatility. But if this market finds a way to go bullish and get back to that seasonal pattern of November, October, November being a bit of a dip or a bit of a sideways move, and then going higher by the end of the year, if that seasonality plays out, cool. I'll take my stabs with some options, generate some income. So we looked at that stock last week RL was not sitting at all-time highs, but that was one that I'm like, I'm not buying it right now. PGR, Progressive, was one. I'm trying to think some of the other ones. Eli Lilly's way up near the highs. Lockheed Martin's way up near the highs. Some of these defensive plays, ExxonMobil, some of the energy plays, like, just not interested in buying highs. I don't think that's too much to ask. I'll just be patient. Okay. All right, good stuff. Okay, everybody, I'll wrap it up there. We're 2 minutes from opening bell or from closing bell. We're looking like we're going to retest today's lows, and it's fine. Let's see what tomorrow gives us. I'll be watching my gamma squeeze levels, see if these light up at all. If these contracts and open interest levels to the downside get bigger, and all of a sudden my combination that generates this gamma squeeze index gives me these indicators, and we're sitting at this huge position at 561 or 560, then I'm probably going to take a long put towards them. And then see if the week will play out that way. I might do it with a bear put spread, and just the hard part is if it's a long put, I can take profit anytime. If it's a bear put spread, I pretty much have to wait till expiration. But I do have the ES hedge. We talked about the SPY hedge with that broke wing butterfly. So there's a couple income plays that I've got running this week just for some type of pullback. So if we get it, cool. I kind of hope that we do. But we'll talk about it some more tomorrow. Okay. Thanks, everybody. Have a good rest of the day. I'm going to let this 1 minute. I'm going to give you all 1 minute back until closing bell. But I'll see you tomorrow. Tomorrow morning, daily profit play in the AM. 10:15, I'll be live with A1 Trading for another live session with them. And then 3 p.m. final hour. Let me see if I have any additional webinars this week. If you'd like to join me tomorrow, so I've got a final hour session Tuesday. And at 4 p.m., right after this session, I will be doing a live webinar on my daily profit play. If you'd like to join me, I'll post that in my Discord. I'll post it here in the YouTube channel. So we'll probably wrap up tomorrow's final hour about 3:45 or 3:50. And then if you'd like to join me for a live webinar, I'll be live again at 4 p.m. And other than that, have a good rest of the night. Happy closing bell. Market's finished in red. And we'll take a look at everything tomorrow. All right, thanks, everybody. Take care. Bye.